Good afternoon, everyone, and thank you for joining us for this installment of Epic Insight. This is Brian Lenz, Director of Sales here at Epic Retirement Plan Services, and I'll be your host for today's call. We're excited to be joined once again by the one and only Ken Entenmann from our NBT Wealth Management family to share his less than dry economic outlook during these tumultuous times. Ken is a Senior Vice President, Chief Investment Officer, and Chief Economist at NBT Wealth Management, and he brings to the table over 34 years of investment experience and oversees more than $6 billion in assets under management and administration in trust, custody, retirement, institutional, and individual accounts. Ken is a former board member of the New York Bankers Association and was the chair of the Trust and Investment Committee. He's a chartered financial analyst and earned a degree in applied economics and business management from Cornell University and his MBA from the University of Rochester's William E. Simon Graduate School of Business Administration. Quite the resume. As always, your line will be muted throughout the call, but if you have any questions you'd like me to run by Ken at our conclusion here, please do enter those into the questions panel. And with that, I will turn it over to Ken.
Well, thank you, Brian, and thank you, everyone, for joining us today. I'm excited to be back here and look forward to seeing all you folks in person at one of the Epic conferences. Hopefully, we'll get back to doing those in-person meetings. So I think we're in interesting times. The Fed just had their announcements today, which went according to what we thought. And so what I'd like to do is kind of take you through where the economy has been, where we think it's going, talk about some of the obstacles to that growth, namely some labor shortages and supply chain shortages, and of course COVID, and then turn our attention to the interest rate markets and the equity markets, where I think the best is behind us. That doesn't mean the equity markets are going to go down in value, but I think it's going to become a lot more choppy and a little bit difficult to kind of wring out gains going into 2022, and we'll try to articulate that, the reasons why for that. So let's take our first look at, kind of looking backwards. And, I think the chart goes back to 2018, but you can see that we were kind of trending in that 2 to 3% range in the past, and then COVID hit. So you can see the beginning of 2020, where we had a world record minus 31.4% GDP drop in the second quarter of 2022, almost entirely due to the lockdown at the original introduction, the first wave of COVID, and the attempt to, if you remember back, to flatten the curve. We locked down the economy for 2 or 3 weeks and extended that, and didn't quite work, but nonetheless, that combination of -5 in the first quarter and -31 in the second quarter is truly historic in proportions. And I think the world became very dark because we expected that lockdown at the time, because we know so little about COVID, and we had so few tools to combat it at that time, that there was a projection that we could be in lockdown mode for 1 or 2 years. And the market's reaction, the actual economic shutdown was obviously painful, and the market reaction was really, really painful. World record, quickest 20% decline in the S&P 500. But then suddenly we kind of discovered that this might be not as bad as we thought. And first of all, from a stock market standpoint, we quickly learned that, yeah, it's bad news, but some companies are going to be clear beneficiaries of COVID, and some are going to be clearly hurt. So if you think of companies that were in the software industry, streaming companies, Peloton, athletic wear, companies like that did phenomenally well with COVID, and obviously things like hotels and restaurants and airlines fared poorly. But nonetheless, you can see that rather miraculous recovery in the third quarter of 2000, up at 33%. And since then, we've been more or less running above economic trend. The first half of 21 was really, really strong, with GDP coming in excess of 6% in each of those quarters. And then the Delta variant hit beginning in August of this year, and really took its biggest toll in September, and it really curtailed economic activity down to 2%. Then we started rallying back, and I still think the fourth quarter will have some pretty decent growth. It remains to be seen if Omicron, the new variant, really impairs economic activity. I think it's had some impact, but I still think you're going to get above trend growth. And when we look into the year 2022 and look at consensus estimates for GDP growth for next year, the market's hovering right around that 4.5% to 5% growth. So that's pretty solid growth that we still anticipate coming in 2022. And so that, to me, is really good news. Obviously there are things we need to continue to worry about. Most importantly, this is COVID. That generates incredible uncertainty in terms of where we're going, and you can see the kind of waves, and you can see the Delta wave, that little hump in July and August and September, but that came and it quickly kind of dissipated, and then Omicron's come, and we've seen the cases go up a little bit higher. I would point out that most of the cases in the United States are still Delta variant. I think, and I'm certainly not a medical doctor, but I think we hope that Omicron kind of becomes the dominant variant, because while Omicron is more contagious and therefore it transfers faster, by most accounts, at least so far, the symptoms are very, very mild. And if we can get people, so I think there's room for optimism here that even though the numbers are spiking, if it's because of Omicron, it may give people exposure and therefore future immunity to COVID without getting terribly sick. And obviously that's what we wanted. So you can see these numbers. We just surpassed 800,000 deaths in the United States. So that truly is tragic. But from an economic perspective, we are far from where we were at the beginning. Obviously, we have vaccines, and depending on which state you live in, somewhere 60 to 70% of the population has been vaccinated. We're just starting to vaccinate children. And obviously, there's a big chunk of people who've had COVID, whether they know it or not, that also have immunity. So I think we're not quite there, but I think we're close to herd immunity. In addition, we obviously have vaccines that have proven to be pretty effective, maybe not so much in contracting COVID, but they've certainly been highly effective in curtailing the need for hospitalization and certainly death. And that's really encouraging. This week we had Pfizer come out with their pill that is somewhere around 89–90% effective in preventing hospitalization and death. And so we simply cannot rule out COVID as a risk to the economy or the markets in 2022. But I suspect as we kind of roll through time, the acceptance of COVID and our ability to manage it, I do not anticipate you're going to get an all clear signal where everybody can come out from behind their mask and come out and return to quote unquote normal. I don't think that's going to happen. I think COVID's going to become endemic, much like the seasonal flu and the common cold. But our ability to manage it, I think, is increasing by the day. And it's my sincere hope and expectation that COVID, while it's front and center today with Omicron, will begin to fade in terms of an economic risk. Not go away completely, but I think hopefully fade away as a major driver of uncertainty. But clearly today it's a pretty hot topic. The other hot topic in the marketplace is really inflation. I think this chart really sums it up. And just this Friday, we had our CPI number come out at 6.8%, which is the highest reading, I think, going back to 1969. And then on Monday of this week, we had the producer price index come out at 9.8, which is the highest on record for that number. So I really think inflation is becoming kind of a core risk. And the Fed in their last minutes, and they literally just got finished with their press conference moments ago with their bi-monthly meeting, and they retired the word transitory. So at first, the expectation for inflation was it was going to be transitory, meaning we knew when we got into April and May and June of this year that we would be comparing inflation to the lockdown period of the original COVID episode, and we knew inflation collapsed, so that we'd have this kind of mathematical spike in inflation. But we thought once we got through those difficult comparisons, inflation would begin to fade away, and it would be therefore transitory. At the last Fed meeting, the Fed kind of, and I'm quoting Chairman Powell, said that he was going to retire the word transitory because inflation has remained far higher than the Fed forecast, much more persistent and more pervasive. So when you look at the numbers that came out on Friday and Monday, it's just about everywhere. It's auto prices, it's clothes, it's food, it's housing, it's electronics, it's appliances. So it's very pervasive throughout the system. And I think that's going to remain a challenge for both the Federal Reserve in terms of monetary policy, and clearly it is impacting the fiscal policy discussion in the halls of Congress and in the White House. So I think this is something that we'll touch on in a little bit. Our position is that we do think inflation will subside as we go through time in 2022, but I'm in the camp that it will remain higher and a little bit more persistent and persuasive or pervasive than what even the Fed is expecting, and I'll explain why in a few seconds. I think the good news is I would call one of the adjustments, the behavioral adjustments that we've made to our world, both as consumers and as business owners, is what I would call the great deleveraging. And so I summarize this with the personal savings rate. You can see how that has skyrocketed in the lockdown. Most people remained employed, or even those who were unfortunate and lost their jobs were supported through enhanced government benefits, unemployment benefits, so that cash flow remained fairly consistent throughout the COVID crisis. But you couldn't go out. You couldn't go to the restaurant. You couldn't go to the movies. You couldn't get on a plane. You couldn't go on vacation. And so the savings rate has spiked. And I think the uncertainty that still remains in the economy about COVID has left the personal savings rate hovering in and around 8 to 10%, which is much higher than where it was prior to COVID. At the same time, individuals have taken the opportunity to pay down credit card debt, pay down that home equity loan, pay off student loans, pay off the mortgage, so that we have the most deleveraged or strongest consumer balance sheet we've had in a long, long time. Flipping over to the business side, whether you're talking about Fortune 500 companies or smaller family businesses, they also have taken this time. They were supported with PPP loans and other government supplemental programs. And the net balance is that cash balances on the corporate side have never been higher. They have also taken the opportunity to pay down debt. And I think the combination of this great deleveraging leaves both the consumer and corporations and businesses poised for fairly robust economic growth if and when we get past COVID. Now, as I said earlier, I do not expect there's going to be an all clear signal and COVID's going to go away. So I think this is going to be a gradual process. But I think once the world's confidence builds to the point where we say, yeah, we know about COVID, but we can manage it. We have a lot of healthcare tools to deal with it. I think we're close to there, perhaps not there yet. But I think as we roll through 2022, we're going to get there. And this great deleveraging has resulted in a lot of dry ammunition and dry powder sitting on the sidelines that can help fuel economic growth. One of the things that came out of COVID, which will lead to one of the constraints that we're worried about, which is supply constraints, is there was a rather dramatic shift in spending away from services. So think airlines, restaurants, resorts, things of that nature, and into spending in goods. And you can see that was true in Europe. It was true here in the United States. A gigantic spike in spending on stuff. What do I mean by stuff? It's remodeling the house, it's paints, it's appliances, it's new computers to stream at home. It's that big flat screen TV. It's building the basement, putting a new porch on the house. That's all stuff that's done that resulted in a dramatic shift. So we basically stopped buying airplane tickets, stopped going out to restaurants, stopped going on vacation, and basically fixed up our houses, excuse me, and paid down debt. And that, I think, really shocked the market because we have been a service-driven economy, and it really flipped it on its head, where service used to be 60% and manufacturing goods were 40%, and we inverted that. I do think this chart, which gives you the PMI for manufacturing service, you can see how manufacturing is kind of flatlined and services have spiked up. This was before Omicron, but I do think we're kind of trending towards a return to a more normal economy, which is more service-driven. I can tell you in the last few weeks, I personally spent a week on vacation in Arizona. I can tell you every flight I was on was sold out, every airport I was in. And then this past weekend, I flew down from Syracuse to Tampa to go watch the Bills get robbed of a victory against the Tampa Bay Buccaneers by the referees. But nonetheless, flew down there, spent the night at Disney World, and then drove over to Tampa. Once again, airlines, all the 4 flights I was on were sold out. The airports were packed. Disney World was packed. So I think we're gradually returning to a more service-oriented economy. But nonetheless, that turn to goods really shocked our supply chain. So I think we're all familiar with all these tanker ships sitting off the coast of California outside the port of LA and the backlog of all those containers pictured in the bottom picture. So that surge in good demand really kind of created the supply chain disruption. But I also believe there's been some government policies that have at least exacerbated these things. So obviously just the shift in goods put pressure on commodities. So steel prices, copper prices, aluminum prices, lumber prices, with demand for homes, single family homes, as people fled the cities and looked for new residents back in single family homes. There's still a 5 million single family home shortage today. So I think that demand will continue. I also think that some of these policies were somewhat self-inflicted. We've had tariffs coming out of the Trump administration that I think were kind of penny wise, pound foolish, that increased commodity prices. I think we've had energy policies that are very well intended in terms of trying to control climate change. But in my opinion, they're not ready for prime time, meaning the demand for fossil fuels still remains very high. And effectively, those policies have cut off the supply of fossil fuels. And the net result is materially higher prices for fossil fuels, gasoline, natural gas for heating. And I think that problem is far more chronic over in Europe than it is here in the United States. So I think that's kind of a policy mistake. And one of the reasons why I think inflation may be more persistent, whether you agree with the policies or not, is not relevant. But I really doubt that the Biden administration is going to come back and say, you know what, let's finish the XL pipeline and let's allow fracking on government land so that we can increase the supply of fossil fuels. I don't think that's going to happen, and therefore I think some of these supply constraints may last a little longer. But I certainly think getting through the excess demand of that the holiday season brings every year will begin to dissipate. So I think there's a seasonality to the supply chain that will help. And I think we will get better at producing things. And, take semiconductors, the last thing listed here. There is a number of plants being built here in the United States. Intel is building 2 plants to the tune of a capital investment of close to $20 billion. But it takes time for those things to work. So I think supply chain will get better. I think the demand will soften as we return more to a service-oriented economy. I think the demand will soften because we're getting through the holiday season. And I think production will increase. But I think all of that's going to take time. And that's one of the magical questions, is how long does that take? And will inflation remain more persistent than the Fed is hoping? That, to me, is one of the big risks for the marketplace next year. The second area that I will tell you, I do a lot of public speaking for the bank. I've had 3 presentations to clients in the last several weeks. And I can tell you every business that I talk to is struggling with labor. Now, the good news is the unemployment rate has dropped pretty considerably. It was 4.2% in November, which is kind of right back to where it was pre-COVID. So that is really good news. But wages are going up materially, and there is still a pretty big labor shortage. So when you look at this chart, which is what we refer to as the JOLTS index, which put out by the Bureau of Labor Statistics, this measures the number of job openings that are listed out there, and it also tracks what's known as voluntary labor turnover. So these are people quitting their jobs, and generally speaking, you don't quit your job unless you get a better alternative. You have a better alternative someplace else. So it's a sign of strength if this number is high. And the last reading was there's over 11 million open jobs in the economy today, which is fantastic. But the problem is the unemployment rate has dropped, but the labor participation rate is still very low. It got a little bit better in November, and that's encouraging. But right now, the estimates are that there are roughly 8 million people out of the workforce not participating in the labor force, whether they're unemployed or just disgruntled and have left the workforce. So you think this would be a relatively easy mathematical problem to solve. 11 million job openings, 8 million people unemployed, mix them together, voila, you got a really robust economy, and the labor shortage goes away. But I think this is going to take a little bit more time, because when we examine the 8 million, this is based on JP Morgan. Michael Semblis did this work, really great work. But when you look at the anatomy of the labor shortage, and you look at that 8 million, roughly 2.7 million of those people are people that were earning more in unemployment benefits than they were in their private job. And this is predominantly low-income workers working predominantly in the leisure, hospitality, service sector. So think of bartenders, waitresses, dishwashers, flight attendants, people working in the restaurants and the shops and airports, etc. Now, the enhanced federal benefits that were an enhancement over normal state unemployment benefits expired in September. And in November, we started to see this crowd start to re-enter the workforce, but we're a far ways away from getting this 2.7 million people back, because it's not only just unemployment benefits, it's rent moratoriums, it's payments for children, child care credits, tax credits, et cetera, that all add up to make the decision of enter the workforce or stay at home a little bit more economically challenging than what meets the eye. So good news is this number is starting to come back in, but I think it's going to take a little bit of time. If you turn to the right side, the next area, which is about 1 million people, is what Semblis refers to as excess retirees over trend. So we can kind of plot out, we know the baby boom generation is getting older, and there's this big mass of workers that are going to retire over the next 5 to 10 years. But it's estimated that over 1 million people retired earlier than expected, above trend. And part of that is that these people were at threat of getting laid off, so perhaps retiring kept better benefits for them, healthcare benefits, for example, as opposed to if they were laid off. And so the question is, will these people remain retired, or will they re-enter the workforce? I think some of them will come back. I think some of them will find out it's not as cheap to live in retirement as they expected. It's certainly a lot easier when the markets are up as robustly as they are. But nonetheless, that's another 1 million people. So 2.7 plus 1 million, that's 3.7 million of our 8 million. If we add the next category, which is about 800,000 people, these are temporary workers or immigrants that would have entered the workforce just by getting their green cards that allowed them to work here in the United States. Well, the government got backlogged during COVID because of the impact on the federal workers in and of itself. So there's about 800,000 fewer temp workers working in it. And then lastly, a lot of people took the COVID crisis as an opportunity to exit the workforce and start their own businesses, whether they're selling stuff on the internet. Think about an electrician who might have been working at a hotel and got laid off, so decided to start their own electrical business and are working as kind of a private contractor. So that type of thing. People who might have been working in a low-income job and start their own landscaping business, that kind of transition. Think about people who've lost their job and became Uber drivers is a good example. And that's about another. So when you sum it up, it's roughly of that 8 million people, this explains about 6 million, a little bit less than 6 million of that people. And therefore, I think it helps explain why the labor shortages are so chronic. Now, do I think many of these people will re-enter the workforce? The answer is absolutely yes. But I think it's going to take a lot more to coax them back in. I think they'll come back gradually. So again, this is what it helps fuel my thinking that the labor issues that the economy is struggling with may be a little bit more persistent and more prevalent, and inflation may remain higher than normal. So let's turn our attention to the financial markets and interest rates. The Fed met today, so this chart is officially obsolete as of about 45 minutes ago. But the reaction, I think the Federal Reserve and the federal government in general deserves great credit for their really swift reaction when COVID hit in February of 2020. They cut interest rates to zero, where they remain today. They initiated all kinds of bond market support, and their biggest weapon was this quantitative easing, where the Fed was buying about $120 billion of securities every month, mostly longer-term securities, $80 billion in treasuries and $40 billion in mortgage-backed securities, all in an attempt to suppress long-term interest rates, and the lower interest rates would spur on economic activity. I think it worked brilliantly in the housing market because housing prices are up nearly 20% year over year. But now the question is, with inflation running as high as it is, should the Fed be continue to buy securities? And today, the Fed announced that last month they announced that they would start tapering, and you can see it in the red box below that they were going to start with $15 billion. Well, today they announced that they're going to be tapering by $30 billion per month. So what does that mean? If you were buying $120 billion a month and you were going to taper by 15, it would take almost a year to get through that tapering process. If you're reducing or tapering by 30 billion and you're buying 120, you should be done in 4 months. So that was the highlight of today's meeting. And what it's also done is pulled forward the consensus estimate for the next Fed rate hike. And this, to me, has been the most dramatic. And the Fed dot plots confirm this as well. So if I look at the Fed funds futures market, they are applying, or at least prior to the Fed announcement, implying a 60% chance that the first rate hike would occur in May of next year. And if you look at it, if you say, okay, they're going to taper, and the Fed more or less has said they wouldn't hike rates until they finish tapering. Well, if they do the 30 billion, December, January, February, March, maybe April-ish is when they're done tapering, that would suggest the first rate hike would come shortly thereafter. There's no guarantee of that, but that's what the market's anticipating. And the market has priced in 3 rate hikes for 2022 at 25 basis points a pop, with the first one occurring in May. That has pulled forward and is much more aggressive than when we were even a month ago. And I think that, when you look at the equity markets, that could prove to be problematic. I think if the economy recovers and COVID becomes more manageable, as I hope, I think those rate increases are more than digestible by both the economy and the market. The question is, will this forecast hold true, or will inflation remain more problematic, and therefore the Fed has to be more aggressive? I think that is really the crux of the question as we look at of the issue looking into 2022. On the fiscal policy side, this is legislation coming out of Congress and the White House. Again, I think that early intervention was highlighted by the CARES Act, was robust, was highly effective. The PPP loans, which NBT Bank played a major role in, highly effective, followed by a $900 billion supplement in late December of last year, followed by another $1.9 trillion of stimulus in February when the Biden administration took over. We've recently passed an infrastructure bill, and the question remains, with all this liquidity in the marketplace, is that a source of inflation? And so right now, the big question is whether this social or human infrastructure bill, as it's being called, and depending on who you ask, it could be $1.2 trillion, or if you extend out, the full non-expiration of a lot of the programs, it could be as much as $5 trillion. That is being hotly debated, and I don't know whether it's going to happen or not. But in short, the combination of continued highly accommodative monetary policy and fiscal policy has left the economy awash in liquidity. Huge cash balances on consumer and commercial balances. Banks like NBT have record level deposits on the Fed balance sheet. And again, I think that's great news for dry powder. I think it does also help fuel inflation. And if we get even additional more spending, that could add to that problem. And I think that's really what we're debating in Washington upon the fiscal policy standpoint. But right now, the economy is awash in liquidity, and I think you see it in some of the more speculative areas of the marketplace, the special purpose acquisition companies, the SPAC market, the IPO market, art market, certainly high-end real estate have all been just jumping through the roof. And I think there's a highly speculative area in the stock market that has gotten beaten up recently because they're finally realizing the Fed is going to start to focus on inflation and perhaps raise rates sooner. And of course, our debt levels are part of this discussion, and the debt levels have skyrocketed, not just in the Biden administration, they've skyrocketed over the last 10 years. And one of the weights on the market and the uncertainties in 2022 is Congress has not done a really good job of explaining how they're going to pay for all this. And on this page here, I give you a host of things that have been thrown out there, kind of throwing spaghetti on the wall to see what sticks. And there's all kinds of controversy there. I do think the global minimum tax of 12% to 15% is kind of the leader in the clubhouse, but I don't think that comes anywhere near funding what we're talking about. Because of Senator Kristen Sinema and Joe Manchin, I think corporate tax rates have been taken off the table. Higher tax rates for individuals, I think for now, and my biggest fear as a chief investment officer was talking about capital gains. That seems to be off the table. The SALT tax is being highly debated. And then the last thing that's really been bandied about is the bottom right is the wealth tax. It's really easy to say I want to tax billionaires and we're going to tax their unrealized capital gains. In practice, I find, and ask any accountant it's almost impossible in real life to do this because the value of a Picasso or a farmland or a vacation home just varies so much that if you're taxing it on the value this year, but what if it goes down next year? Do you get a tax loss carry forward? It's just really challenging and particularly problematic for family farms and small businesses. And so I don't think that has, I think it sounds great, tax the billionaires. In practice, it's tax family businesses and tax farms, and it's really difficult to execute. So I think it remains to be seen how we do this. State taxes, my biggest fear is the capital gains situation, and if you make that onerous, that could put a crimp in the market, particularly given the robust gains that we've had. So let's turn our attention. We talked about interest rates. Quickly finish up with the stock market. It's interesting this year. The stock market, S&P is up, about 23% year to date, about 26%, a little over 25% in the last 12 months. And what's interesting, and I'll share a chart with you in a second, it's really all due to corporate earnings. So that the PE ratio of the S&P 500 has actually come down, even though the S&P is up 23%. That's a little unusual. Normally, when the market is up as robustly as it is this year, it's because the PE expands because people are confident. And in fact, the earnings have been so strong that the PEs come down. Nonetheless, it is still well above the historic average of 16 times earnings. So it is difficult to suggest that the market is cheap right here. I do think you kind of discount the level of the PE right now because interest rates are so historically low. But either way, it's difficult to say that the market is cheap. It's not as expensive as it was. And certainly, I think there are pockets of the market, as we talked just a few seconds ago, the SPAC market, the IPO market, the meme stocks. If you think of AMC and GameStop and Robinhood, those stocks have all seen significant corrections in their valuations. So I think the PE ratio going forward is fairly reasonable. And the thing that I find encouraging is that corporate earnings have been spectacular. So you see the collapse of corporate earnings both here and in Europe, far more severe in Europe in reaction to COVID. But you can see the recovery of those earnings and where they're projected to be. The second quarter of this year, so that clearly the comparisons year over year, we're comparing to the second quarter of 2020, which was the heart of the lockdown. So the earnings had a really low bar, and they were spectacularly strong in the second quarter. And year over year, S&P 500 earnings quarter over quarter, second quarter grew 90%. That's really just off the charts good. And it was 60% in the first quarter. And you can see the forecast, and this is just the forecast of FactSet, that they continue to forecast really robust earnings. That's really what's driving the market. And it was that earnings growth that allowed the PE to come down. So even though the market went up considerably, the price went up, but the earnings went up faster and had the PE ratio come down. And that's the good news. So the question, though, is when you look at, kind of decompose where equity returns come from, they really come from, 4 different areas. It's what are the earnings, what are the dividends, what is the currency impact if it's a foreign company or an international company, what is the impact of the contribution of currency translation? And then, there are periods when the PE multiple of a stock or a company or the market itself either expands or contracts. And if you look at the U.S., almost all of the total return generated, and you can see that diamond in that 23% area, almost 100% of the earnings this year, or the total return that stocks drove this year, were because of robust earnings. The dividends are always there. Sometimes they're bigger, sometimes they're smaller. But currencies didn't really add any value. And the PE multiple, as we talked just earlier, contracted, so it didn't add to the return. And so going forward, I look at this chart and I say, okay, what's the probability that earnings are going to continue to grow as robustly as they are? I still think earnings are going to grow materially, and that's good news. And I think, therefore, a bear market in equities, I think, is highly unlikely. I just think it's going to be much more challenging because, think about next year's first quarter earnings season. We're going to be comparing growth to 60% earnings growth in 2021. So anything less than 60% earnings growth is going to result in a contraction in earnings. That's really a high bar to me. And therefore, I think we cannot expect to get that kind of earnings power contribution to total return in 22. And we have to look to the other areas to support total return. I still think the returns will be positive, but I think it's going to be a lot more choppy. And the risk is if inflation remains really high and starts to eat into corporate earnings, that could really prove to be problematic. But we're pretty optimistic that stocks will have positive returns in 2022. So let's kind of rapid fire sum this up. COVID and Delta and Omicron really remain a concern. I do think the tools that we have to combat it, I hope and expect that we will enter into the COVID is not as big of a risk because it's manageable. And if I think we can get a higher degree of confidence in the manageability of COVID, I think the markets will be poised, the economy and the markets have considerable upside. I think Omicron has kind of put a dent in that confidence for the time being, and hopefully it will be short-lived. The equity markets trade at near record levels. The PEs have contracted but still remain historically high, but we think they're reasonable given low interest rates. Transitory inflation has proven to be anything but. It's been very persistent and pervasive, and it's clearly in the focus of the Fed. As I tried to articulate today, supply and labor issues I most definitely think will improve, but I think it will take time, and how much time I think is critically important to what the Fed has to do in terms of interest rates and what Congress can maybe pull off in terms of fiscal policy. But I do think it will improve. It'll become less of a risk, but it will take time. But I still think it's going to be fairly persistent and pervasive through the economy. We talked about the Fed tapering and its announcement today, which again pulls forward kind of the tightening of, we'll certainly be in a less accommodative mode for the Fed. And once we get through the tapering, we're going to start the tightening process, which if inflation remains elevated, may have to be much more aggressive than what the market is currently forecasting. GDP is still growing at 4 or 5%, significantly above trend. There is liquidity everywhere, strong consumer balance sheets, strong corporate balance sheets, terrific corporate earnings. So I think it's a cautiously optimistic view of the world next year. And again, there's still an abundance of risk. We just touched on the virus, supply chain, whether the Fed has to accelerate the tightening process, adverse tax policy coming out of China or coming out of Washington, reemergence of China, lots of things to worry about. But it leaves us saying, we think we're pretty optimistic about 2022. Not that things are going to go up 23, the S&P is going to go up 23. I think it's going to be a much more steeper wall of worry to climb for the markets next year. But we're pretty optimistic on the economy growing, and we're pretty optimistic that the stock market continue to hold its own. And I would hold out that if in fact COVID does become less of a factor, and the Federal Reserve kind of threads the needle and gets inflation under control without having to raise rates too aggressively, I think there's considerable upside because of the strength of the balance sheets and corporate earnings power to have a really terrific economic growth in 2022 and fairly robust markets. But I think we got to kind of work our way through the risks that we've articulated. So with that, Brian, I hope that's a whirlwind tour of the economy. I'll be happy to take questions.
Yeah, indeed, Ken. Thank you for that. And thanks to everyone for sticking around. I know we spilled over a little bit. If you do have a question, please enter that in the panel there. And Ken, good on you for giving the Fed and the government some kudos there. I don't hear that very often from economists. So nice work weaving that in. And I think the big question that always folks are interested in, without giving investment advice, you mentioned all of the powder that's out there these days. What do you have any themes of where you might or where one might deploy that liquidity in this environment?
Well, I think if you take my discussion at face value, I am hard pressed to say that interest rates won't be going up next year. It doesn't mean they're going to go up a lot, but even if they remain flat, it makes returns in the fixed income space have been pretty paltry, and I think they'll remain pretty paltry. And if anything, the total return in fixed income would be negative if rates in fact do go up as the Federal Reserve is forecasting. So I would say that our preference would be towards equities versus fixed income. And then if you look at some of the charts I shared today, and given the returns that have been generated by the S&P 500, and I certainly acknowledge that international investing has not provided anywhere close to the returns that the U.S. markets have had, but the international markets are far cheaper. The earnings were far more beaten up in COVID, and therefore I think the potential for the earnings recovery in Europe, I think they're a little bit behind our curve, and their markets are far less expensive than ours. So I think the concept of diversifying your equity exposure is a theme that I would suggest may be beneficial in 2022.
All right. We'll hold you to that. Look back next year, right?
Okay.
Well, thanks again, Ken, and the NBT Wealth Management team. And of course, thanks to all of you for joining us for this Epic Insight webinar. We will follow up with a copy of the slides that Ken shared, along with a link to a recording of the session. And we certainly appreciate your partnership. Wish you and your families and colleagues a happy and healthy holiday season. Thank you very much, all. Thanks, Ken.
Great. Thanks, everybody.